Hello, everybody. Thanks so much for taking some time with us today, and welcome to Precision Pricing, Unlocking Profit to Outperform Competitors. We're going to talk today about some pricing essentials as you gear up for 2024. My name is Matt Greenstein. I'm a principal with the Alexander Group, and with me I have Michael Stanisz, a partner with Revenue Management Labs. And Michael's going to spend some time with you today and share some of the things that we're working on with clients as we help gear up for 2024 on the pricing front. Today's webinar is one of a four-part series, and so if you hadn't had a chance to join us for August session, I encourage you to go back and check that one out. And that one was kind of focusing on some pricing imperatives as you look to close out 2023 strong. This one is now, as we're kind of, for those on calendar fiscals looking at 2024, where are some areas to focus? And then we'll have a third and a fourth session coming your way as we wrap the year and get into 2024. So without much further ado, I'll kind of set up the session today and kick it over to Michael to share with you some of the insights. We're going to focus on a few things today. Number one, we're going to talk about the importance of budgeting for pricing at a very granular level. And as we kind of get into that topic of budgeting, we're going to focus on some best practices in the area and hopefully leave you with some actionable steps to monitor progress as you get well into 2024. And so Michael's going to hit on those 3 points, and then we will open it up for some Q&A via the chat as we wrap the session here. So encourage those on to go ahead as we go and plug in your chat, and then we'll pick Michael's brain a little bit as we wrap. So with that, Michael, I'll kick it over to you, and let's get us started.
Thank you very much, Matt. So just to get everyone kind of aligned on why we decided to kind of talk about budgeting and planning out that pricing process for the next year, it really stemmed from some research that we did at the end of last year, where we evaluated high-performing companies who were able to hit their revenue and pricing targets versus low-performing companies. And one of the things that we found was that the higher-performing companies spent a lot more time thinking about their annual pricing process, reviewing a lot of their pricing metrics, and making sure that they were prepared to take their pricing into the new fiscal year. In fact, 80% of the companies who we identified as high performing actually engaged in annual pricing reviews, and that's compared to only about 56% of the companies who were low performing. At the same time, something that was really interesting to us was that those high performing companies, almost about 3/4 of them, used pricing as a strategic lever to manage some of their demand and supply. So they knew at a very granular level, if they moved price, what would happen to their supply and demand. And that was less than 50% for some of the low performers. So it really opened our eyes and made us think about, as companies get into looking at what's coming up for the next fiscal year, we spent a lot of time on budgeting and planning, but we don't hear a lot of people talking about pricing. So we want to make sure that everyone's thinking about how they budget their pricing, and it's really top of mind because it's a real differentiator that separates the winners from the losers. So let's talk about a couple of different ways in which you can actually do that, because what we hear a lot of the time is, yep, I've budgeted my price and I'm going to take 4% next year. And that's really, really good that people are thinking about that and they're putting that in their budget, but that's not really granular enough. And it's really important that people are thinking about moving that top line price, but they're doing it at a granular level. The last couple of years, we've seen a lot of inflation, and we've seen it be a little bit easier to push price. You walk in the grocery store nowadays, you walk anywhere, prices are up from where they were several years ago, and nobody's really asking any questions. As inflation's kind of slowing down a little bit now, it's going to be more difficult to pass those standard list price increases than it was a couple of years ago. And this is a lever that a lot of people went to because it's quick, it's easy, it's relatively low risk, especially with the climate that we've had. But it's really important that as you think about going into 2024, you're thinking about how do you become more strategic with those price increases? How do we get away from the peanut butter spread of 5% across the board to looking at our portfolio and our segments to say, these types of customers, these types of products, you need a little bit more of a targeted price increase as opposed to the general spread that people have been used to over the last couple of years. So we're not saying don't think about taking that frontline price increase, but think about it in a very granular and strategic way and how you make sure that you get at it so you can really take advantage of those gaps that you might have. The second lever that you can pull that people don't talk a lot about is you can leave your frontline price alone, but what you can do is you can actually reduce the discounts that you have to your current customers. The nice thing about this is you can get really, really targeted on an account level to get that profitability and fix some of those outliers that are kind of sitting there, and it's relatively low visibility. Tough part is when you go into a discount reduction lever, you need a lot more analytics. You need to really have a good understanding of what your profitability is on a customer. It's a little bit slower on the implementation, and you need to make sure that you have a good selling story to take to that customer about why things are changing. And the whole goal of reducing these discounts is to figure out which of these discounts aren't driving incrementality and where can we find some synergies and how do we truly drive that incrementality. When we look at some historical rebates, we look at some of these terms that might have been in place, are they trying to drive a customer behavior or are they there because they've just been there for the last 5 years? So this is a really great way of thinking about how you can drive that net price without having to drive that frontline price. The last lever that we talk about when we talk about budgeting your price adjustments is thinking about mix. Now, mix is something that not a lot of people do out there. It's quite rare, but really the goal with mix is to drive customer value via premiumization. And the beautiful thing about changing the mix and how customers are buying is that it's a long-term change in behavior. You're not only going to get the benefit next year, but you're going to get the benefit for years to come. So it's long-lasting. The downside is that you have to have a deep understanding of who your customer base is. You have to get a good, deep understanding of what the segment is and what their needs are. And typically, it requires a little bit of a sales effort to be able to go talk to these customers, to really think about what the story is, to get them to drive into that more premium offering. The nice thing is that mix, discount, and price, you can look at all these levers at the same time. You don't have to rely on one of them. It's one of the things that you should be thinking about, that how do I look at my holistic net price increase that I'm trying to get in 2024, and how much do I expect to come from each bucket? Because you can be much more strategic, you can really drive that incrementality, and you can start to increase that customer value. So we encourage everyone not only to look at the one on the far left, which is where most people tend to sit when they think about pricing, but bring discounting and mix into the equation as well. So with that said, let's talk about a couple of best practices as we go into 2024 and as you're thinking about budgeting those pricing increases in there. The first one that we wanted to kind of bring is really around the market benchmarking. And it's really, really important that as you think about bringing your price increase or your price change or any price that you're trying to look for, you have a good understanding of what the market is. And when we say market benchmarking, there are 3 things that we really think you should focus on. The first being, what are the trends that are happening in the market? The second is, what is your price position in that market? And the third thing, often overlooked, is what is the value that we're driving versus the rest of the market? So let's talk about these in a little bit more detail. When we think about market trends, we want to get an understanding of who are the competitors in the space, how has their price shifted, how has their discount shifted, how has their model shifted, and what has happened over the last year, or if you haven't done it in a while, the last couple of years, to really see the difference between when you initially priced your offering and where it kind of sits today. The other thing that we want to include in that market trend is, how have customer buying behaviors changed? I'm sure everyone's got a story over the last 3 years coming out of COVID, how their buyers have changed. They're smarter, they're looking at things in different ways, they're asking different questions. What impact does that have? And how can we think about that from a pricing context as well? one of the big things that we talked about in the market trends is identifying who those competitors are. But it's not only good enough to identify who they are, we need to get a good understanding of where are they positioned from a price standpoint. And when I say position from a price standpoint, again, going back to what we were talking about, that frontline price is really important, but we have to have a good understanding of what kind of discounts are they giving? What kind of incentives are they giving? What does that mean on a net level? A lot of times we see companies go out and benchmark that frontline price, and they don't get into the detail of benchmarking the discounts, and that can have a huge impact. The other thing, when we talk about benchmarking price and understanding your price position, it's really important that you think about doing this at a granular level, because it tends to vary a lot when we look at across a portfolio. So typically we hear a lot of people tell us, oh, we're a premium priced offering to this competitor. And while that might be true on certain pieces of your portfolio, oftentimes the pricing benchmark and where you sit in the market is different across the portfolio. You may be premium priced in some spots, you may be at a price disadvantage in other spots. And that goes not only across the portfolio, but a lot of the times it's regional as well. You gotta remember that the cost structures are very different, so it's really important that you're going down and doing this at a granular level to really understand where do you have those opportunities to take more price or offer less discount. The last bucket that we encourage people to do when they're going out and getting a benchmark is understanding what the value is. And this is really difficult sometimes because it takes a lot of work to understand how customers perceive what you're bringing to market versus your competitors. How do your different segments perceive that? And this really ties in a lot to what your go-to-market strategy is, because if you're thinking about going after certain segments and what they're valuing and what price we're kind of offering to them, it's really important that we understand what that value is for each of those segments. And like I said before, it could be very different across the portfolio. It could be very different across the region. So it's really important that we're looking at that value on a granular level. A couple of key tools and tips that we like to throw out in a good pieces of analysis when it comes to kind of benchmarking and how to really think about that process is really go out there, get a good understanding of who your competition is. Make sure you have a good understanding of what segments are out there, not only in your portfolio and your offerings, but your customer, and how does that competitive benchmark overlay? Some competitors are going to be relevant to some, but not to others. As you think about those different segments, start to think about what guidelines you're going to develop from a pricing and a discounting standpoint, and make sure that you're overlaying that value to understand what the value is for each of those different segments. So really important. If there's one thing that I could encourage you to do as you go into 2024 is make sure you have a good benchmark of what your market is. Second best practice that we're going to talk about here is really getting a good anticipation of the cost structure here. Now, there's a lot of different costs here, and I'll just wait for the slide to come up here, but there are a lot of different costs that we can look at. We're going to have internal cost drivers and we're going to have external cost drivers. And why it's really important to understand the difference of the external versus the internal cost drivers is the external cost drivers, usually those are the same things our competitors are going to face. We're in the same industry. Sometimes we're using the same supply chains or similar supply chains. You know, our labor markets are probably very similar. Getting an understanding of that external cost structure could usually give us a good hint at how much price does competition need to take to offset what the cost is coming in. And at the same time, we're going to have our own internal costs, the way we do business. It's going to be different than our competitors. So having a good understanding of what that is going to be important too. But it's important that from a pricing standpoint, you break it out, because it's going to give you a little bit of a range of this is the pressure that competition is going to face, that I'm facing as well. And this is the pressure that I'm facing that competition might not be facing, or even more so, they may be facing more pressure than that. But why we always tell people to understand their cost structures is that a lot of the time when companies are looking at price as part of their budgeting process is they're looking at how much am I going to increase price, and they expect that to flow to the bottom line. And oftentimes we don't look at it at a granular level to say, if we do nothing, what's going to happen? How much is our margin going to compress? And then Once we understand that, we can start to think about how much price do I need to offset to not only maintain the margin profile that I'm looking at, or possibly expand, or whatever corporate goals that you're going after. So it's really, really important to think about that cost structure as a whole. I come back to the survey that we did at the end of last year with those high performing companies, and we looked at a couple different metrics. And what you see on the bottom there is you see those gray bars are firms that perform below their aspirations from a revenue and margin standpoint, and those blue bars are firms that performed above their revenue and margin aspirations. And what's really interesting when we look at the solution brand improvement impacts, one of the things that we see a lot of the time is that these companies spent a lot of time increasing the offers and increasing the features behind their product. So it's interesting because they were investing and they were bringing in more cost into the structure. They were improving their offering, yet they were able to achieve those revenue and margin targets because they were able to show the value behind that. So it's something that we like to call out, because a lot of the times when people think about spending incremental money or incremental costs, they think that there's a trade-off that I'm not going to necessarily be able to get the improvements that I need. But if you can start to price for those things, you can still have lots of success. The other side is the cost pressure factors. And this was really interesting to us when we looked at the companies that were they using cost as a way to take price, or were they, so the cost increases due to inflation, were they looking at how much is my cost gonna go up? Am I gonna offset that with inflation? Or was the cost driven by really a lot of people having kind of some of those supply chain issues? And what's really interesting there is you can see that the high performing companies, they were low on the supply chain issues. So what that told us is that those companies had a really, really good understanding of what their cost structure was, and they were able, if you remember what we talked about before, they were able to move that price to monitor that supply and demand. So what's really interesting is by having a good understanding of this cost structure, you can focus more on how to drive that frontline cost and it's not going to necessarily sneak up on you like a lot of these companies had with some of those supply chain issues. So it's really, really important not only to kind of think about your internal, but external, and you see some of the results that we see out of there. And last but not least, the last insight or tip that we wanted to kind of give here is really, and I talked about it a little bit early, but really thinking about how we start to leverage mix in our portfolio to drive incremental profitability. As I mentioned before, we've seen a lot of inflation over the last probably 24 months. That inflation has started to go down. It's not going to be easy to push a price increase as it was 12 months ago. Inflation is down, and these numbers might be a bit dated by now, but it was down about 60% since the peak. And that's a year-over-year change in price. So what that means is that we have to start thinking outside the box. Now that inflation is slowing down, we're not going to have that easy price increase that might have existed over the last 2 years. And we have to start thinking about how we change the way in which we can drive customer behavior. And the way to do that in a long-term sustainable way is mix. We really recommend that as you think about your planning process, think about what impact mix has on your P&L and what that actually does to your net price. And one key way of breaking that out is to start not only monitoring what's happening from a rate standpoint, but start monitoring what's happening from a customer mix standpoint. And when we talk about mix, there's two big buckets that we talk about. There's customer mix, and then there's our kind of product portfolio mix. And you can think about, how do we shift our volume? How do we make sure that our more profitable customers are a bigger piece of our business? That could mean walking away from some customers that aren't necessarily as profitable, and vice versa on the product side. How do we move people into some products that are higher margin? And ways that we can kind of start to think about that, we call it looking at the white spaces that exist out there. Are there new sizes? Are there new offerings? Are there unmet needs? what's the total dollar amount that's kind of coming out of that pocket. And what's really, really important as you think about this last mix bucket is making sure that we're linking this mix bucket to the segmentation that we have. My guess is that most of you in your organizations have some kind of customer segmentation where you understand the needs. So starting to look at how we can think about using price as a strategic lever within those segments to meet those needs is going to be really important over the next 12 and 24 months, because we're not going to have this inflationary bubble that we've had over the last 12 and 24 months. So with that said, the key takeaways that we want to make sure that you guys are thinking about going into 2024 is really making sure that you're looking at not only your price, but you're going to look at that competitive price. Make sure that you're going out and doing that competitive benchmark. Now, I talked about a lot of things in that competitive benchmark. I talked about the pricing, I talked about the value, the trends. Even if you can't do all of it, try and do some of it. Try and get an understanding of your key products, your key customers, your key markets. Get a good understanding of what your price position is and how that's changed over the last 12 months, because that's going to have a big impact on what you might be able to push in terms of a pricing standpoint over the next 12 months. Secondly, make sure you got a good deep understanding of that cost structure. As I mentioned, internal versus external cost structure. It's really important that we understand both, because it's going to allow you to scenario play not only what your pricing aspirations might be, but how much pressure you're going to see from the competition. And the last thing is start to think about mix. Mix is a tough lever to pull, and understandably, you're not going to get there in 4 weeks by just getting into a room and brainstorming. It takes a real conscious effort to start thinking about how do we get a deep understanding of that customer? How do we fundamentally change what our view is and how we're coming to market and what our offering is and what our story is to drive people into those more profitable offerings. So this is something that you need to really start thinking about, because as that inflationary pressure continues to come down, this should be a bigger and bigger piece of our pricing toolkit for actually gaining price in the years to come. With that, I think we have some time for questions. Is that right, Matt?
Yeah, we sure do. Great stuff, Michael. Thanks so much for the insights. And so, encourage folks to leverage the chat here, but maybe we'll kind of get things started with a couple of questions. The first one, you've talked about the importance of market benchmarking. How often should companies be going through that exercise? Is it an annual process? Is it a quarterly process? What are your thoughts on timing?
Yeah, that's a great question. What we typically advise is that you probably want to look at least on an annual basis at a minimum. Now, if there are significant market shifts, so let's say a new competitor enters a new region or something happens, you may want to look at it a little bit more. But at a minimum, you should be trying to go through that market benchmark at least once a year. And just thinking about a couple tips as you go through that market benchmark. A lot of the times it's really easy to boil the ocean and say, I have 40,000 SKUs, I got to go get a competitive price for each of them. That's never going to happen. So a lot of the times, some industries you can get some kind of syndicated data to help. That's a great way to offset some of the hard work. But if you don't have that syndicated data, try and break out the benchmarking into your key product segments or your key service segments and think about getting a small sample. Typically, what we would recommend is look at some of your highest performing, most important, highest revenue categories and try and get a good benchmark for those, because those should give you at least a little bit of guidance. And as I mentioned before, don't only focus on what that list price or gross price is. Make sure you get a good understanding of what the discount structures are as well.
Yeah, got it. So maybe some pitfalls to the market benchmarking. One is not doing it at the granular level that you talked about, the peanut butter spreading, but on the other side of that continuum, it's boiling the ocean. And so you got to maybe find the right sweet spot between the two.
Absolutely.
Another question here. While it sounds fundamental to understand your cost structure, I suspect that there are some companies that might not be there yet. You might be kind of scaling and growing, or it's a complex business and challenging to understand it at the level that you described. If companies don't get there, how can they apply some of the principles that you talked about today if they're still trying to figure out some of the fundamentals with their cost structure?
Yeah, there's two things we would recommend in that standpoint. One is what we find a lot of the times, and we actually just finished off an engagement with a company who they were trying to get to a perfect cost structure, and they were spending so much time trying to get everything down to the last penny. And what we found was that as we went through the math, we said, well, even if your cost structure is off by 100%, we're still going to get to the same business decision. So a lot of the times on that cost structure, if you can get close enough, it's good enough to drive some of that pricing decision. So even if you don't have a good understanding of fully baked fixed costs and how that spreads across the business, looking at it from a variable standpoint might be the first step. So don't be afraid to take it stepwise and optimize your pricing on the variable component and layer in maybe something on the fixed side that is directional at best. The other thing that when we look at those cost structures and what those impacts would be is really thinking about how we start doing some sensitivity testing around it. So like I mentioned in that example with the client that we were working with, they could have been wrong by a factor of 2 and the business outcome would still be the same. So really get a good understanding of what that cost structure looks like and what the sensitivity, if you were to be off by a little bit, does that actually change your fundamental decision? And one of the things that we often talk about is, cost is important to understand when you're making a pricing decision and into your annual planning, but it shouldn't be the only decision. So that's why the market benchmarking that we talked about and getting that perspective, it's important to overlay the two of them, because not only are we going to want to understand what's happening in the market, but it's relative to the cost. So if we're making our decision only on cost plus, we probably, and we're not confident in those cost plus numbers, it's probably a sign for us to go out and get some of that additional information, such as that market benchmark.
Yeah, makes sense. We have time for maybe one more quick question. You've talked about the importance of segmentation, throughout the discussion today, in particular when starting to apply some of the premiumization or mix principles. Take us through a little bit of that process. How do you go through figuring out, the segments where you can differentiate mix, and maybe what are some of the behavioral metrics that you and your team look for?
Yeah, absolutely. And where we always start out with the segmentation is typically we see people have done a segmentation. It's usually around demographics or different pieces of data. What we always say is bring in some of those behavioral metrics. So a starting point that we always look at is we start with the RFM model, which is recency, frequency, and monetary. So how much is that customer spending with us? How often are they spending with us? And when was the last time that they've spent with us? And if we start to use those are some metrics that can usually give us a pretty good indication of how sticky these customers are and when they're kind of coming in. So a lot of the times you may have a lot of information that someone comes in, but they might do one big deal a year, whereas someone who's kind of coming in, buying a bigger breadth of the portfolio, and they're coming in multiple times a year. Usually when we start running some of those elasticities and we start running some of that, those analyses to drive mix, we get very different results. But what I would say is really focusing on the behavioral and usage, how much they're spending, what they're spending it on. Those are really, really good places to start when you're thinking about some of those behavioral metrics.
Great tips. Well, Michael, thanks so much. This was fantastic. So at the last minute here, I'll go ahead and wrap up. Well, thank you everybody for spending some time with us. Join us for our next webinar on cost plus pricing, why you are leaving money on the table. And so that'll be Wednesday, December 13th from 2 to 2:30 p.m. Eastern time. So look for the invite there. And should you have any questions, you can feel free to reach out to Michael and team at the Alexander Group. We would be happy to share further insights with you, and encourage everybody to log on and download our mobile app where you can access some of the research that Michael highlighted during the session today. Well, thanks so much again, everybody. Have a great day.